And, you know, this BOJ decision is turning out to be a whole lot more interesting and potentially, you know, how much pain could we see just shatter these markets if we do actually see a surprise?
Yes, good morning. Shattering's probably a bit of a harsh word, but yes, we almost got to the end of the week with expectations for what central banks were going to do being delivered upon, and then this last-minute hurdle of the BOJ seems to be getting higher. It's probably no surprise that the Bank of Japan should be considering a tweak to their YCC policy, given the level of wages growth, the level of inflation, and let's not forget there's always a political dynamic in Japan. So, you know, with the unpopularity ratings of the incumbent Prime Minister at their sort of lowest levels, there is potentially some sort of demand for a change to policy there. And what we saw last time when the BOJ did tweak their policy was quite a significant move in the yen and yields, and particularly you mentioned Australia there, markets like that where Japanese investors have been significant holders. We could see some underperformance of markets like that, at least in the short term.
Is that your base case scenario, though, when it comes to what you're expecting or what you're pricing in for today?
Our expectations heading into the Bank of Japan was no, they would not be tweaking at this juncture, but ultimately they're going to have to. And even then, a tweak in policy, if you think about the significant interest rate differentials that still exist between the BOJ, the ECB and the Fed, you know, that unwinding of, say, a carry trade where a lot of investors are underweight the yen versus overweight a whole range of higher yielding currencies, you know, a stronger short yen in the short term to a BOJ tweak might be an opportunity to actually re-engage with those trades rather than potentially unwinding them.
So I'm curious what you think about the bond market broadly. We're talking a lot of focus now on the 10-year JGB, but this kind of action from central banks feeds through to markets. Where do you stand now on where we should be, if anywhere, in fixed income?
We should be adding, and there's a few reasons for that. But using the US as an example, you know, the level even of short-term rates, so US 2-year bond, you know, getting towards that 5% level with a policy rate at 5.5% level is pricing in quite a significant sort of stable economy rather than a typical shift of policy for 6 to 12 months of stability into an easing of policy. The market is not priced for that any longer. So there is value in the short end of the yield curve. And then when we think about, say, longer-term valuations, if you look at the level of real yields up around 2% in the US, so even if investors are worried about inflation, in some markets you are sort of getting some reward for holding a bond and getting that inflation risk taken off the table.
What about China? You know, everyone's waiting to see if more stimulus comes, you know, to boost the economy, or the government's going to keep dragging its feet. Again, if I'm looking at securities, if I'm looking at investments, where should I be?
You probably shouldn't be in Chinese government bonds, which is a pity given our exposure there. But we've been reducing that since the middle of last year, and you know there has been volatile with the reopening, waxing and waning. But again, yeah, we do think that policymakers' commitment to at least stabilising the economy is quite powerful, given the announcements we've seen and the potential likely further announcements in the next couple of weeks. So Chinese government bonds, you know, likely to drift back towards that sort of 3% level rather than 2.5% level in the second half of 2024. So that's a market which is probably you'd be underweighting in your portfolio rather than other markets such as the US.